I want to just get your take first on the Fed meeting and the statement that we saw. Do you see the same as what the Fed is right now, which is that we may see a more robust economic growth, and that could lead to faster rate hikes?
The economy certainly has momentum. The economy is getting a very large fiscal stimulus for this stage of the cycle this year. And so, absolutely, I would expect that to lead to a faster pace of rate hikes, and we might finally be in a place where both the Fed and the markets are in sync with their expectations, and the Fed follows through on what it says it's going to do.
Okay, Jason, just hang on one second. We've got some breaking news right now on the earnings front. Of course, we've been following lots of earnings news in just the last few hours. eBay coming out with their earnings as well. Fourth quarter adjusted EPS, 59 cents. 59 cents is their reporting. The estimate was also for 59 cents per share. So coming bang in line with estimates, and the same thing eBay on the net revenue portion of it, 2.6 billion. Estimates from among Wall Street analysts at 2.61 billion for eBay. So we'll continue to follow these headlines coming out from the company. However, but we just got those, so we'll be watching for more details as they come out from eBay. Jason, I want to just mention, though, obviously the economy seems to be, at least from looking at some of these numbers and reading this Fed statement, a little bit more robust, perhaps, than anticipated, or at least it's heading that way. Alan Greenspan, we spoke with him, the former Fed chairman. He's talking about some risks in the markets, and in particular asset bubbles, and I want you to just hear what he had to say earlier today on Bloomberg.
I think there are two bubbles. We have a stock market bubble and we have a bond market bubble. I think in the end of the day, the bond market bubble will eventually be the critical issue. But for the short term, it's not too bad.
Would you agree with that?
Bond yields were falling well below before the financial crisis. I think there's a lot of good reasons that bond yields are low and prices are high. The stock market is a bit more iffy, but valuations are somewhat consistent with a world where you have a very low discount rate because you're expecting a low rate of return going forward. Either scenario, though, if the stock market bubble bursts, or if the stock market keeps going up, but going up more slowly, will not be able to sustain the rate of consumption we've seen in recent years. The personal savings rate has plummeted. That's happened because of this large rise in the stock market. That's not a sustainable basis for growth going forward. So if we are to firm up at 2 to 3% growth, we're going to need much more productivity growth than we've seen recently, because the demand side won't be able to carry us like it has.
Jason, I want to get your thoughts on, this is a chart that we've been going back to over the past few days, because we have been hearing from the president taking credit for the economic recovery, talking about stock markets hitting, record high after record high. But this is essentially a chart. This is G#BTV 2777 on the Bloomberg, a chart that shows the decorrelation, the disconnect between consumer sentiment, which is rising, and presidential approval, which, as we know, is the lowest that we've seen in recent memory. How would you explain, I guess two parts to my question. One is, how much can President Trump actually take for this recovery in terms of credit? And the second part of my question is, how do you explain a situation where you have the economy and people feeling better about the economy, but also feeling not so great about leadership?
Sure. So on your first question, I think people always overrate the impact that presidents have on the economy. Very few of President Trump's policies were in place in 2017. And in fact, the U.S. growth surprise has been smaller than the growth surprise in other advanced economies. That's part of why you've seen a weakening dollar, because Europe is really leading the global recovery. And at this stage, the United States is a follower. In terms of those consumer confidence numbers, what I find interesting is they've been somewhat disconnected from the actual economy. Consumer spending is growing much less quickly than you would predict based on the consumer confidence reports people get. So they're telling surveyors one thing, they're saying they're confident, but then when they go to spend their money, in the supermarket, they're not spending in a way that's consistent with that. So, my bottom line is I wouldn't pay a whole lot of attention to the confidence. To have the economy grow on a sustained basis, we're going to really need productivity growth, wage growth. We're going to need those fundamentals. You can't just levitate yourself on optimism and hope.
Jason, you mentioned the dollar, and I found this statement from PIMCO on the dollar overnight really intriguing. The head of PIMCO saying that the US is waging and winning a cold currency war in terms of covert actions and words, jawboning essentially to bring the dollar lower. Do you think there is a weak dollar policy as possibly suggested by some of the rhetoric that we've heard from Trump, from Mnuchin, from Wilbur Ross?
I don't think there's a weak dollar policy. In fact, there seems to be unintentionally a strong dollar policy that for some reason isn't working. Large tax cuts, that's a recipe for a stronger dollar. A faster rise in interest rates, that's a recipe for a stronger dollar. So when you look at the actual policy actions, they should all be pushing the dollar up. The surprise is that we haven't seen that, and I think that tells us more about the surprising growth in Europe, Japan, and the rest of the world than it does about any policy changes here in the United States.